Our next panel is on uranium, which I'm sure will be popular given the pricing at the moment. We're calling it Uranium Renaissance, Powering the Clean Energy Future. And joining me up here will be Guy Keller, Portfolio Manager, Nuclear Energy Opportunities with Tribeca Investment Partners, and Nicholas Crowther, Principal Advisor, Energy Minerals Council of Australia. I thought it makes sense to start with the price, obviously, and what's actually happened. So uranium, as everyone in this room will no doubt know, spent a lot of time in the cellar. Everyone talking about what was going to happen. It never did for a long time. And then 2021, it went to 50 bucks. And then more recently, last year, it's gone past 100, come back a little bit. Since then, what happened? Guy, do you want to start us off? Or you're looking at Nicholas?
Well, I mean, it simply comes down to fundamentals. I mean, out of all the commodities we look at Tribeca, it's got the biggest discrepancy between demand, which is really easy to model because it's just goes for years and years and years, and it doesn't matter about economic cycles, and supply, which has had a decade of under supply from primary mine supply due to a whole bunch of other reasons, and we're playing catch up. The markets recognise that at $20, at $40, at $60, we're not going to be able to incentivise supply. And even recently, with the spot moving to $106, the market's waking up to the fact that price is not going to solve this necessarily. There's a whole bunch of other things that need to happen because we've had more than a decade of neglect in exploration and development projects. So it's pure fundamentals.
Okay. Nicholas?
Yeah, look, I mean, everything Guy says is obviously very correct. Not just the uranium renaissance, but obviously the nuclear renaissance that's driving it. You look at reactors around the world and a lot of the stock is quite aging. There's a number of reasons behind that. Coal was cheap. There were obviously some incidents in the 3 Mile Island and Chernobyl that really took the foot off the pedal when it came to installing nuclear. And so there's, as Guy said, the forecasts were quite easy on the uranium market. It was easy to see where the demand was. Now, obviously, we're in a whole different paradigm now. We're in a situation where very large energy users around the world are trying to understand how they're going to make the transition to net zero and beyond. And increasingly, nuclear is seen as the solution to that, along with renewables. So yeah, that's increasing demand, obviously.
Guy, you mentioned primary mine supply didn't come on as one of the drivers for the price increase, and you said, and other things. What other things? Or you said for various reasons. What were those reasons that people didn't get behind uranium?
Well, so, I mean, we had a pretty healthy sector in the early 2000s. The GFC derailed that, as it did a lot of sectors. But it was very quick to come back in 2009, and we started pushing back up again. We saw the emergence of China as well there, and I've spent 25 years trading commodities and physical commodities before I moved into fund managing. And one of the things there is that when China make a structural move into something that it's a decades, and if they're short the raw material, which they are, uranium, it provides support for that. And we've seen that with copper, iron ore, you name the commodity. And so Fukushima derailed all of that. Japan shut down their reactors. Germany was very vocal, turning theirs off or decommissioning, putting a huge amount of pressure on Europe to retire reactors early. And so the price went sub $20, which meant that a lot of these mines weren't economical. The Kazakhs were 40%, they were ramping up into 2011 and stayed up. So, plus you had a huge amount of inventory. You had megaton to megawatt, which was Russian nuclear warheads being downblended into civilian fuel in the United States. Secondary supply, that was basically free uranium for US utilities. And that's all gone now. That stopped. The inventories have been drawn down to almost critical levels if you think about the way utilities think. Remember, utility doesn't necessarily care about the price of uranium because it's such a low cost of their operating. They care about not running out of fuel. In fact, that's their first 3 rules. Don't run out of fuel, don't run out of fuel, refer back to rules 1 and 2. And they're making a decision not for 2024, but for 2026 or 2027, because unlike coal and gas, uranium goes through a fuel cycle. You can't just shovel it off the truck into your furnace. You have to put it through conversion, enrichment, fabrication. That used to take 2 years. Now with Russian sanctions around the war in Ukraine, that's more like 3. So utilities having to think, do I have the orders in the system for fabricated fuel rods in 2027? Which means today's economic environment's irrelevant to them. They're saying, how much do I need then? And how much do I need for the 5, 10, 15 years? And that's what's driving this at the moment is they've, as I said, had a decade of free uranium. Now it's not there. And they're starting to say, wow, I need to make some decisions.
Okay.
And enrichment and fabrication is becoming quite a choke point as well, noting that with the bifurcation of global markets, particularly around with Russia and China uniting. Now China, there's some numbers out there saying by 2030 we'll consume half of the mined uranium globally every year out from there. So as we need to ramp up to manage that. But the other problem is that most of the fabrication enrichment is aligned with China and Russia, and that's going to be another kind of choke point within the supply line for uranium.
Yeah.
With a supply problem or challenge, Guy, you said it's the price alone won't fix it. I might be unkind and actually ask Nicholas to answer why you're saying that. That feels more like it might be in your wheelhouse.
Yeah, look, I mean, we've seen some great investor pitches so far. Just take Australia as an example. I won't talk to other markets, but you've got uranium-friendly mining jurisdictions such as Canada and Kazakhstan, who are the big world leaders, along with Namibia. We come in 4th in Australia. We've got 30% of the world's uranium assets and some fantastic ones at that, yet still we're the 4th biggest miner in the world. And why is that? Well, unlike coal or iron ore or critical minerals, we treat uranium completely different for some reason. Well, you can imagine the reasons, but in Australia we choose to treat it differently. And not just from an Australian point of view. I mean, we've had the 3 mines policy, we've had outright bans on uranium, but that doesn't exist at a federal level anymore. We're now down to a state-by-state proposition. And I won't maybe not touch on this too much now, but one of the main problems we have in Australia is just getting to the point where we can turn a shovel on some really good uranium assets from a country that has almost 1/3 of the uranium. So that's a huge supply challenge.
Okay. Investors may be concerned looking at energy transition drivers for the uranium price and the opportunity there, looking back at what happened with battery minerals or battery metals last year. What could we tell them, or what could you tell them, not me, about why this isn't a bubble? Or do you think it might be?
It's not. This is not lithium. Yes, we've seen a pullback in the spot price from $106 to $84. That can be very easily explained by uranium physical market being quite possibly the worst commodity market in the world. And I've traded a lot of them. It's a small handful of people. It's largely irrelevant. Most of the uranium prices on long-term contracts with global utilities, where nuclear is only part of what they do. So they're not tuned into it. They're not in the market on a daily basis. As I said, they're sitting there looking at their inventory saying, we probably need to contract, and when we do, let's do 5, 10, 15 years out. And then they're out again. So it's very different from that respect. The other respect is, unlike lithium, where when the battery electric vehicle sort of revolution sort of started happening, we were unsure about demand and supply of lithium. So, the battery capacity and demand was building out with supply. We hit that choke point in 2020. We then skyrocketed in the spodumene equivalent and the other equivalents after that choke point was solved. The difference is uranium is starting this thesis with a 10-year neglect, 15-year neglect, and a primary mine supply deficit. So the price is moving. We also have the biggest reactor build program in decades, 62 odd reactors, largely from China, but also India and 10 other countries, which is adding another 30 million pounds of demand in the next 5 to 6 years. So we're about 190 to 200 million pound demand and about 130 to 140 million pounds of primary supplies. We've already got a big deficit. We're adding another 30 million pounds to that. And so we can't solve for yesterday's supply deficit. We can't solve for today's, and we're looking ahead seeing tomorrow's. Whereas lithium right now, you're balanced hoping that Western Gigafactories complete on time and on budget and at capacity, and 2027 to get your supply deficit again. That's not the case with uranium. The other difference is OEMs, the battery makers, the car manufacturers, were funding some of these lithium projects. They were providing the capital. That's not happening in uranium. Uranium, the utilities are hoping that the market, guys like me or banks, will fund the hundreds of millions of dollars, or in some cases billions of dollars, to put these uranium projects up. And they're going to wave a piece of paper around and say, we've given you an MOU that will buy your uranium when it's produced, and saying, why aren't you building the mines? It's like, because the capital has not looked at uranium for more than a decade. So find me a banker that's going to sit there and go, oh, yes, I'm happy to go to credit committee at Macquarie or Bank of Montreal or Export Bank and say, here's a uranium project, and we need $1 billion for it. So that's why it differs in my view to lithium, and I think that it continues because we're only, as I said, we can't solve for yesterday's deficit.
Okay. Yeah, look, and on the nickel, you talk about lithium. On the nickel side, we talked about Sila Waste in the Chinese-Indonesian partnership. There's just no option for that within the uranium market. As Guy mentioned, the secondary supply is all but gone, and there is no alternate pathway to source uranium. It has to come out of the ground at this point.
So why or should we be looking to the utilities to start doing offtake agreements like we see in other spaces? Is that the natural next step?
Well, you see, they're signing long-term contracts, but they're not allowing the developers to divulge the information. So for analysts, it's very hard to model what's the future cash flow of this uranium producer, because I don't know what their minimum or maximum uranium price is going to be, so I can't put it in my model. I don't necessarily worry about that so much. There'll be a point in time where I have to, which probably gets me employing a young analyst to do it. But they don't actually put any money up front. So they say, when you're producing, we'll give you this collar and take the uranium from you. By the way, if you don't get there in time, we're going to punish you, and you're going to have to find that uranium. But they're not actually providing any financial incentive. It's just a piece of paper with a bunch of legal, mumbo-jumbo in it.
But surely if that's not doing the job and their first 3 rules are make sure you're supplied, that will change.
I mean, again, when you're a utility and you're a nuclear fuel buyer who's also planning your refuel of your reactor, which is every 12 to 18 months and can be thousands of people depending on how big your reactor is, you're wondering about where you are and your orders with you, and you go to the board and say, hey guys, I know we do coal, gas, hydro, renewables and nuclear is 20% of what we do, but can I have $1 billion to give to a bloke who's standing next to a hole says it's going to be a great uranium mine in 5 years' time? I mean, it's a real hard sell for a fuel buyer to take that to his or her board of a utility where it's not a big part. An OEM who says, we're building batteries, so therefore we want to go and buy the lithium, the cobalt, that's different because that's all they're doing. So, yeah, I mean, eventually one will get creative and hopefully others will start. But again, there's no wall of supply. There's a handful of projects they can fund in the near term that will get production at the end of this decade outside of what we're seeing coming on. There's no magic, there's no second Kazakhstan out there.
No, and on the $1 billion request, Australia makes it pretty hard also from a legislative point of view to de-risk that sort of investment. So, look, the Australian industry has a long way to go in terms of competing with Canada and Kazakhstan in terms of attracting that kind of investment.
Guy, you talked about the uranium market being one of the, I forget the term you used, but it wasn't great. It wasn't a good term. Not a great trading market. Sprott waded into the market a few years back. They're buying physical. What has that done to the market? What kind of influence? And was that a product of essentially the problems in the marketplace?
No, I mean they restructured a vehicle that was sitting under in Canada, which is UPC, and they restructured it to be much more dynamic in that they were able to tap the market for basically at the market funding when it traded at a premium as opposed to going through a company route of discounted capital raises and things. there was a lot of fanfare in August, September 2021 when they came to market. They were very aggressive. They moved the price. That coincided with crypto, Bitcoin people looking at meme trades and GameStop, and coincided with all that. So uranium got sexy and all the junior stuff, and it went boom, straight vertical. And everyone blames it on Sprott, Physical Uranium Trust. I think they certainly brought attention to the sector. The interesting thing is that we've seen a move from the 60s to $106, and a very quick move from 80. I mean, it was $80 in mid-November, and suddenly January it was 106. Sitting on the beach thinking my screen was broken. But Sprott wasn't involved in that. They'd bought very few pounds, and that to me was very reassuring, because it was saying, and of course, yes, there was a handful of hedge funds, but can I tell you, from somebody who tried to set up a physical uranium trading account years ago, it's not easy, and it's certainly not as easy as it was last cycle. There's a lot of hoops you have to jump through, and then you have to set up with every trader. It's a real... So there's not as many financial players as there was last cycle. So the fact that we moved to $106 without that financial speculation, or the hedge fund gaming, or what you want to call it, was reassuring to me, because that was real business going on, and just highlighted how thin and dysfunctional that physical spot market is.
Noting I'm on the political side, not the economic side, in that November period, we did have COP28, where you had a sign-off by 20 world leaders, including the US, UK, Japan, UAE, India, to triple their commitments to nuclear. And I think that sent a big signal to the market that this is a long-term game.
Just conscious, we're not short on time, but there's a lot of supply side stuff to cover. Nicholas, starting with you on the policy, what's the opportunity in Australia around potential policy shifts, and where do you see them having the biggest opportunity and impact on the market?
Yes, okay, so where do you start on that? Okay, for those who don't know uranium that well, it's always where the ground is old and flat, so everything from the Great Dividing Range west tends to be a prospect for uranium. So obviously you've got within that a couple of really big mining jurisdictions, Queensland and Western Australia. And for some reason you can't mine uranium in both of those, which, given that they're happy to sell coal and natural gas and iron ore, it's bizarre that you would have that position. But that is a long entrenched Labor Party position, and we can go back to the histories of that in sort of the Cold War student politics, but they're our leaders now. And so what we have in Queensland is we have a legislative ban, so it is illegal to go mining uranium in Queensland. We've got some great resources up near the Gulf that could be accessed, but it would take an act of Parliament to allow that to happen. Now we're going to see a bit of a contested election in Queensland. The question is, should there be a change of government? Is there political capital in a LNP leader going and changing the law? That remains to be seen. In Western Australia, it's a bit different. We've got again, some very significant resources in the West, but they're locked up in a policy ban. So there's no active law that presents exploration or mining of uranium in Western Australia. In fact, Deep Yellow, who just did a great big cap raise the other week, they'll be the first ones in Western Australia to mine out at Mulga Rock. Really good asset out there. And but the other resources, particularly owned by Cameco, with a really great site at Yeelirrie, one of the best in Western Australia, they can't get to mine because the government just simply on principle won't give them the permits to do so. We kind of note that in Western Australia, the opposition, state opposition could fit in a Tarago, so the opportunity for a change of government next year probably isn't on the cards. The year after that, also the election cycle after that, there is a possibility you could have that position changed. But pressure could be coming from the fact that lithium and nickel is coming off at the moment. If uranium mining was allowed in that state, you could see a lot of those jobs being saved that might travel elsewhere out of the state. Now, where would they go? Well, perhaps to South Australia. South Australia is a really uranium-friendly jurisdiction. Obviously, Olympic Dam, one of the biggest uranium assets in the world, magnificent resource, and Australia's biggest exporter, owned by BHP. Now, in South Australia, they're about to open Australia's third mine, Honeymoon, owned by Boss Energy. That's going into production now. They expect to have, well, they were hoping to have their first drum by the end of the month. In South Australia, there's no problem with mining and exploration. They encourage it. In fact, at our Uranium conference, which I work on with Guy, we had the Resources Minister, Tom Koutsantonis, do a presentation at the start of last year's conference, and he said at the end of his speech that uranium is very dangerous. We should dig it up and sell it as fast as we can. So that's the South Australian view. And if you compare that to what happens in Western Australia and Queensland, which are both under Labor governments, you just have to throw logic out the door. So that's a long way of saying that we've got world-class assets. As I said, 30% of the world's known uranium. But we are the fourth biggest producer behind Kazakhstan, Canada, and Namibia, and the reasons are purely political.
Guy, you were nodding along, particularly at the nickel analogy.
Well, yeah, I mean, you know, there's no better time to make politicians squirm than when you're losing jobs in your state and your electorates. And if you can present them a rational argument to say, you know, there's a commodity that you can mine that's going to give some jobs back, and maybe keep you, and it doesn't matter how big your majority is at the end of the day. So, you know, I think politically there's probably an angle there for some of those producers and developers to put a bit of pressure on Western Australia and see what happens.
Is there some optimism around how fast they stuck nickel on the critical minerals list in response to this, in terms of changing policy quickly to get some of these uranium operations through? Or is that wishful thinking?
I mean, you congratulate everybody here in the room for now being a nickel miner as part of the government bailout. It's, well done.
Yeah, I mean, that was political expediency. And, you know, the problem in Western Australia is there's three of the four unions that control the floor at the Labor Party conference don't want to have it. And that's where they are. They have to, if the Labor Party is going to change its policy, it needs to work its way around that, similar to the way the federal government had to come to an agreement, federal Labor had to come to an agreement in order to get AUKUS up at the national conference. So these things in Labor politics are usually bloody and awful. And the question again is what's in it for the government to get invested in that kind of fight.
Nicholas, could I get you to just give us a bit of colour around the policy in Australia, which you've done a lot on, but then globally, and how it compares and how that's going to affect the supply side and opportunities over the next 2, 3, and then longer term? And obviously, I know you can't comment on specific projects and opportunities, but we'll make Guy do that in a minute.
Yeah, look, as I said, the four major mining jurisdictions really are Australia, Canada, Kazakhstan, and Namibia. And I'll note that there are some really great Australian miners, many members of the MCA, and some we've heard or in the room today, who are mining in other jurisdictions like the US, and they have some really great resources over in Namibia with Paladin, who's a very well-known Australian uranium miner, going to be reopening the Langer Heinrich site in Namibia. That should be back in production very shortly. Deep Yellow's got a site over there they'll be looking at to mine in 2026. So, and Bannerman, of course, have been one of the leaders in pushing uranium mining advocacy, and great operators. Globally, look, one of the challenges is going to be Kazakhstan. As I touched on at the start, very tightly connected to Russia, and the US is a huge uranium consumer for military and civilian purposes. Has passed laws that really are starting to constrain the way that they engage with purchasing uranium from Russia. There's a great acronym I can't think of it now. Basically, it spells no Russia is the acronym, which refers to the way that they're going to start managing imports of these resources. So, and that goes all the way through to fabrication and enrichment as well. So, from a mining, so if you look at the global map, most of the mining and enrichment in the world at the moment is Russia and Kazakhstan. Both are very closely linked, and they're very closely linked with China. So they're basically, with the demand side out of China, supply side out of Kazakhstan, they're going to link up very quickly. The beauty is they can kind of do it without crossing borders as well, which is very useful to them. It's getting increasingly difficult especially with the Ukraine conflict, for Kazakhstan to get its uranium out into Western markets. So it's much easier for them to go due east. Pardon me. So what that does then is put pressure back onto Australia and and Canada, and to a lesser extent the USA, to pick up that supply gap. Now, Canada does this very well. It's got a beautifully integrated, vertically integrated nuclear fuel cycle. Does everything from mining to building reactors to exporting them to fabrication. So Canada can do it all. Lessons there for Australia if we want to be involved in a value add kind of industry, not just dig and sell on the uranium side. But obviously we've got some political battles to get through in order to do that. But there is certainly a huge potential there for Australia. You take that 30% of the world's uranium assets and compare that to where we sit within what will be available for Western markets, particularly those that have signed the tripling of their nuclear commitment under COP. And really, it's all gravy, so long as we can get the legislative pieces in place in order to facilitate it.
What about existing producers and potential for them to expand what they're doing at the moment, keeping in mind the sensitivities around the politics in play?
From an Australian point of view?
I guess I'm looking at Western supply opportunities versus what's tied up in Russia and Kazakhstan.
I mean, if the price hovers under, taking in mind Guy's points around most of the uranium being bought on long-term contracts, certainly the spot price above $75 sends a really strong signal to the market. And pretty much every uranium miner in Australia has said that they're ready to go and start digging holes at $75. That becomes largely even more the case in Namibia. In Canada, they're often flying. So I guess Namibia and Canada will move really fast, really uranium-friendly mining jurisdictions, and they will look to fill that supply gap as soon as they can, as quickly as they can, in places that facilitate that. Australia will get left behind under its current arrangements.
Okay, and Guy, that direct question about where you're looking to place capital, are you taking any political bets, or is it all opportunities that currently are allowed to go forward?
Look, political bets are exactly that, they're bets. And, you know, I've sat in a few over the last 7 years of running this fund, and none of them have played out when they should or how they should. In fact, some of them still haven't played out. So I think, you know, where I'm sort of sitting at the moment is I'm sitting in developers who are doing something. Last year I was a little bit more defensive. I had a very heavy weight in Cameco, had a very heavy weight in Boss Energy. They both outperformed for me, so they did exactly what I wanted them to do. But you know, when coming into February, I shied away from Cameco a little bit because there's a lot of money in there to start with, just fast money, tourist money. But started because the question I was getting a lot was, you know, now that Cameco's runs, what's next? Who's next? Who's going to move at these prices? So you could see capital who'd been sitting in large cap, liquid, dancing close to the door, wanting to filter down the capital stack a little bit. And I already had strong views on the developers I like, those who I think are de-risked, those who put out good studies. So sort of moving there. On the explorer side, it's going to be, and I've just come back from Canada, I was up at a number of conferences, but PDAC was the one that stood out the most, where you know, I met a number of new uranium players who also have a lithium asset, also have a gold project. One had a rare earth project. And it was very similar to last cycle. I mean, last cycle we had over 500 listed opportunities globally that were doing uranium, and about 400 of them were uninvestable because they were just serial sort of reinventors. And you're seeing that already early in this cycle. So I think there's a real potential trap for people coming in looking for those, you know, big 10 or 20 bagger explorers that, oh, this thing's popped up. And so I'd like to, again, those funded who have got programs to explore, because that's what you're there to do, go and put a hole in and find uranium for me. I don't want a mine plan. I don't want you talking about things, what you're doing. So I'm looking there, and also anything that's popping up now, that last cycle, where was it last cycle? Who did it sit with? Why has it been dormant? And is it in the hands of a good team now that can progress it? I think that's really important. If you have an explorer stock that has a good team, is well funded, or has a shareholder base that, you know, that likes to sort of vend out these things and follow these stories, then that's good. And at the same time as well, I think you mentioned Bannerman before, you know, that stock has been extraordinarily resilient because he's had such a really good, loyal retail following, where they've just loved the story, loved the way that Brandon's pitched to them over the years. So if you can find an explorer that's also got a bit of retail loyalty as well, because at the end of the day, retail are a powerful thing in your register that often CEOs forget about, and they go and discounted, equity raise for institutions and 20% discount, and poor old retail investor says, well, what about me? I've now worn that whole move down because you've put it into some Hong Kong hedge fund. So yeah, it's an interesting point in the market right now where there will be questions asked as to who's doing something, because we've all talked about it for a while, and we're at a price point where things should be happening and things should be progressing. So, as I said, it's going to be interesting to watch how that progresses.
The Uranium Club in Australia is a small group, and we all know each other pretty well. And the price spike on uranium over the last 6 months has caught a lot of attention. And my advice from the MCA, who spends a lot of its time in the advocacy space and building up ESG credentials and sort of the good culture of mining, would be that there's a lot of people being attracted to this market on a short-term gain, and if you're looking at it, then there's plenty of ways you can check the quality of the investment you're looking at, because most of the people who really know what they're talking about have been around this for years and years and years.
Okay, just conscious of time. I'll open it up for any questions that are out there. If I could just remind anyone who has got a question, there is a microphone and we are recording, so if you don't wait for the mic, it doesn't get recorded for our virtual audience as well. Are there any questions?
Oh, Bruce,
the uranium miners coming at us. I'll just note, while we're waiting for the microphone, Cameco's purchase of Westinghouse with BlackRock. If you want to see a long-term bet, you've just seen one of the biggest uranium miners in the world go and buy one of the oldest nuclear reactor builders in the world. So they can see where the market's going.
Just wanted to ask you about Northern Territory. You talked about all the other states.
But, another mining-friendly state. There's some complexity up in the Northern Territory. From a legislative point of view, one of the interesting quirks is that the federal government owns all the uranium. It has to be signed off at the transfer point after mining. There's complications around Indigenous engagement in Northern Territory. Under the legislation, it's very different to the freehold you'd find in Western Australia and South Australia. There's some a classic case of that you'd probably see is Jabiluka, which is one of the world's great resources, but for heritage reasons and environment reasons have been locked up. So look, certainly a lot of potential up there. There's some other really good Australian explorers who are doing some work up there. It'll be interesting to see if they can find a pathway to market under current prices.
Guys, probably a question for you, just around contract price. Obviously, the spot market's gotten very thin. Everything's moved back to contract. What's your thoughts on what really is the contract price, given how murky it is?
Yeah, I mean, it's a really good question, Bruce, and I think, I'm certainly putting pressure on CEOs of developers and mining companies that they should be disclosing a little bit more of their pricing, that they're in control now. This is a seller's market. It's not a buyer's market anymore. And the reality is every utility knows what contract's been signed with every other utility because it's a small market and they talk. People point to the term contract, and the term contract is this really weird contract indicator of price where it's the lowest available, not necessarily what transacted. So when you talk to the geopolitics around Russian supply, the Russians can throw out $75 and things are trading at 83, and the reporter says the term price is $75 because you could have bought it there, not where it transacted. As I said, I've never seen a commodity market anywhere in the world like it, where it's like it could have traded there, but it didn't. And so a lot of people will base that term price so utilities like to do collars, floors and ceilings. And then they have a whole bunch of complicated things in the middle of base escalation and fixed pricing and whatever. So you're safe to assume that the minimum price at the moment is probably $75. if there is a developer or a producer going below that, then I'm selling their stock because they should actually be demanding higher than that, in my opinion, because it's a broken price. There's also, though, the point as to when a developer should contract. And there's plenty of people that want to go out there and say, I'm talking to utilities and I'm about to sign a contract. And I say, why? You're 18 months away from production. And as we've seen, prices can move very quickly. So not only did the spot price move very quickly to $106, but the term price went from 58 to 75 quite quickly as well. So if you've locked in my upside with a $50 and $90 cap floor and ceiling, and you're still 18 months away from production, as an investor, there's no upside for me, right? And unless you're doing it to secure debt, there's no point. Wait until you're closer to production. You're going to be able to sign a contract. There's no question about it. If you are a near-term producer of uranium, you will have them falling over you to sign a contract and then layer it in, because as we've seen, trying to sell 500,000 pounds of uranium into this spot market is a disaster because the market just steps away from you and it'll drop $10 like it did the other day.
Nicholas, you're nodding along. Did you want to jump in as well?
No. Everything you said is bang on.
Okay. Any other questions before we wrap up? No, I've got one more, so that will probably do the last 2 or 3 minutes. Staying on the supply side and opportunities, John Forward this morning in his presentation talked about the need to spend flow-through capital in the Athabasca Basin, potentially delivering a huge array of results out of that part of the world. Is that somewhere that investors should be looking for the next opportunity and getting in with a lot of upside still to play? Or do you see, Guy in particular, that risk of rebadged companies essentially just plugging away?
So there is not very much of the Athabasca that has not been pegged, including parts of the Athabasca that weren't even pegged last cycle. As the name says, it's a basin, which means in the middle it gets really deep, and the drilling is not easy. And it's deep, expensive drilling. And as I said, there's a lot of tenements that have been picked up. You're going to see a lot of these things come down to the ASX, they'll be on the TSXV, they may even turn up on the AIM exchange in London. And, yes, it's a high-grade basin, so if you get lucky, Panellists, perfect example, they put out a phenomenal intercept at the end of February, but it was their 84th hole in the time of drilling that project. So, that's a lot of investor dollars that have been spent over that time, a lot of flow-through credits. So, flow-through is something that we should have down here in Australia to encourage exploration because it's popular in Canada and it does give those explorers the ability to leverage that dollar to $1.30, which gives them more chance. But yeah, I'd be wary again, go back to teams that are well funded, that are in parts of the basin where there was activity last cycle. And if it comes to greenfield virgin drilling, the shallower the better in my view.
Okay. Guys, it is all we have time for, so would you please thank Guy and Nicholas.